Good evening, friends. How you doing, Gavin?
Hey, Robert.
Hey, buddy. Sounds like you might be in the car there.
Yeah, I'm gonna be
Come,
pulling into
come.
my house in like 10 minutes.
Oh, cool. Okay. Did your son have a baseball game?
Yeah, last game of the season.
Nice.
Yeah.
How'd the season wrap up?
Oh, pretty good. I'm not even sure what the record was. It was like first season of player pitch, and yeah, he pitched a
I
bunch of
love it.
games, and yeah, they had a lot of fun.
That's great. Yeah, I know you mentioned that kind of at Hedgehog Live that he was really getting into the baseball. So
Yeah.
glad to hear that it was a success. Excuse me, and yeah, I know it's a bit of a haul for you, but hopefully, hopefully that'll maybe slow down this summer a little bit for
Yeah.
you, or maybe it'll pick up. Who knows?
Yeah, he's playing in the summer this year, so he's playing summer baseball. He got invited to do
Cool,
that. Yeah, so
cool,
it'll be action packed.
awesome, awesome. Jimmy, Trent, thanks for jumping on. Always a pleasure to have you guys. Jimmy, you're on your way back you're at the North American REIT conference, right? You met up with REIT Rob, I believe, over the last couple of days. Make it home, okay? I can't hear you, Jimmy, if you're speaking.
I think Jimmy's on mute.
Oh,
Hey guys, I just good evening, by the way.
there
Yeah,
you
I
go.
found you. I had some AirPods in my phone in my hand while I had the connected earphones, so I kept going in and out. I was like, oh, it's okay. What's up, guys? Hope you're all well.
Technology's
Still
tough, right,
tough.
Jimmy? Especially
I'm
for the
not getting any
millennial.
younger, but
Exactly.
Yeah,
Was it a
it
good
was
conference
awesome.
though? You had
Yeah,
a
I
good
think
time? Yeah,
compared to
awesome.
years prior, even though it's the free one in New York and not like $2,000 to register, like a lot of the generalists that might have just been working in the city and wanted to go there for a few hours, like if they're working from home, those people definitely didn't show up. So I think it was definitely more a bit of an average selection of these people that really wanted to be there, wanted to catch up after 2 years. It was like the first meeting in 2 years, so it was really cool to see some old friends and colleagues. And I didn't spend as much time with management teams just because I didn't take meetings, but I saw people walking around the halls and stuff. I caught up with Rob Simone, which is kind of cool. I saw his old boss. Yeah, they had
Nice.
an event, so it's cool. I miss Jeff Gregoire, so he's at Hedgeye too. He's a sales guy, and he covered REITs for a long time. I think
Okay.
he's hopped in here a few times, so I missed him. But it's just fun to get the band back together.
Awesome, man. No, I'm glad to hear it. And always good to get out there and interact, and especially with folks that I know you spent a lot of years in REIT land, so it's passion and it's a passion of yours. So glad to
Sure,
hear that went
for
well.
sure.
Yeah, awesome. Well, we can kick things off. Apologies for being a minute or two late on my end. Kids were needed a bit of a dad scolding to focus on sleeping and shutting their eyes. So sorry about that. But for anybody who's new to this spaces, we're going to kind of give a little bit of a rundown as to some things that we're seeing that are jumping out of our notebook, hence the name. Many of us follow the hedge process, writing down those risk ranges and kind of assessing things that in the market that are of importance, whether it's a bit more near term and the immediate action or sort of more on the trade duration, which would be kind of the 1 month, or trend on the 3 month. And yeah, so with that, oftentimes, Jimmy, you got a question before we jump in?
No, I'm going to let you finish your
Oh,
introduction, and I
okay.
had one point on the conference itself that might be
Yeah.
tangential to our discussion later, so I want to throw that in. I mean, for all you Hedgeye
All right,
subs,
cool.
I spent many years on the long only buy side, so I had a chance to talk to a lot of former peers and competitors, and I mentioned like, hey, have you guys ever been contacted by Hedgeye? Very specific wording, like it reached out and I was still surprised by the dismissiveness and even condescension of them. It was very like subtle, but it was like more along the lines of like, we are fundamental guys, we know what we're doing. And I joked, that the whole conference was people trying to out narrative each other intellectually. Like, well, if this happens, I think this is going to happen. And then, oh, but if this happens, the office REITs say a recession is good for them because right now times are too good and people are working from home. I'm like, are you kidding me? you want aggregate demand to get crushed. Like, again, logical inconsistencies, but especially for people who've been in this space for so long with no generalists at the conference. I mean, like, it's clear that XLRE looks awful, and we're in quad four, even though it's back tested well with VIX so high. Like, people have fled the capital, and a lot of these companies are still good, but they'll even admit like the peak was now or 6 months ago. So like, even though they admit the rate of change difference and the delta, the slowdown, a lot of people are still hiding out because they have to be allocated, right? They have to be allocated 98 to 100%, and it just becomes like magical chairs, right? When there's selling pressure and everyone else is there and you're already there, it makes me wonder, like, on the way back, who's the incremental capital? These guys are fully allocated. If we turn around and get out of quad four, like, they're not buying REITs. We've got other factor exposures that work better. So they came off a period where real estate, private market values, public REITs did quite well. They weren't tech stocks, but they made it past their pre-COVID levels with great mark-to-markets, and the story felt bulletproof. So I think it definitely took people surprise at the end of the year into this year, the heightened volatility, as well as just the lack of, a lot of people underperforming because they're hiding out in quality names, and there was a rotation out of them as capital fled the sector. And I think we mentioned it a few weeks ago where there was like a week where even the winners were losing. That was applicable for the broader markets, and it was applicable for the REITs. Like, look at quarter to date, game over. But again, business fundamentals are good. People are feeling good, but that doesn't always translate to the share price.
That's a phenomenal little snippet of takeaway, right, for many folks here. So you mentioned that you DM me that little nugget, and I thought it was very enticing, very intriguing, and one where good reminder that not everybody puts in the work, or they put in the work, excuse me, but
Yeah.
put in the work in a different manner, right? So
Yeah.
focusing more on those, as you said, kind of a bit more on the model, the fundamentals, maybe the assumptions that are going into them, kind of getting a better realization or assessment as to what those how to tweak those basically data points, right, going into them, versus being a bit more data driven and math oriented. And the title of this weekly notebook review this week is price, volume, volatility impact everything, right? So kind of the fractal patterns, misbehavior in markets is a key book that the CEO of Hedgeye, Keith McCullough, has referenced many, many times. I believe it's kind of a top 3 in the Hedgeye University in terms of quote unquote must reads, and he even wrote a whole early look note on it. So this morning. So if you haven't read that, I highly recommend it. I actually reread it ahead of this call. I'm not going to dive too much into that because that's kind of proprietary information from McCullough and the Hedgeye worlds, but definitely going to touch base on sort of the impact of price, volume, volatility. How to be a bit more engaged with it in terms of assessing kind of those moves and what it means for kind of the risk ranges, right? So there's a lot of questions the last few days, especially yesterday afternoon with RVX kind of moving into the back into the chop bucket, so less than 30 was the impact on those risk ranges, right? And the fact that in a bucket reset or volatility reset, the low end of those risk ranges certainly moved significantly higher, and you saw that across the board in many asset classes, or sort of many assets that we that are provided in the daily risk ranges. But I think we're going to get into that in a little minute. Trend, you often kick us off in terms of some of the things that are jumping off of your page. So if you're willing, why don't I pass you the ball and
Yes.
and
Yes,
we can kick off with that.
Yeah, thank you, Rob.
Yeah,
So today
absolutely.
I wanted to focus on a few things. Number one, I would like to share Chris Moyer's tweet storm. He posted 10 tweets and I retweeted it, but I'll post the first one in this tweetness so folks can follow of how he tracks the price, volume, and volatility. And it's a pretty cool way in which he's tracking factors, US factors, US sectors, and then he occasionally also does a deep dive as well as tracks general ETF trends across the most liquid 100, 150 ETFs. So I'd request you to go through that tweet storm. I think there's 10 of them. It helps you quickly narrow down. Think of it as a watch list of yours, right? So that's first thing I wanted to share because I wanted to be apropos to the title of the space, which is price, volume, volatility, impact, everything. And I would also encourage everyone to take full advantage, whether or not they're a hedge sub or not, doesn't matter, but take full advantage of the free university coaching that's available out there. You can just go to the Hedgeye site for the Hedgeye University or just Google it and you land there and start on it. Having said that, what's jumping off my page this week has been oil. I've been trading the crude oil futures. I also had tweeted about it when oil had taken a sudden beating, when some numbers came out down to 111, 112. I started taking max positions almost in my crude oil futures part. I'm still long those because I've not been trail stopped out. And corollary to that, in the equity world, I've been focused on a bunch of oil servicing majors. So in the tweetness, I posted a few of the estimates that have been revised. For instance, HP or P10, they have their estimates have been revised for earnings by over 100%. So thinking about growth, when people think that, hey, I need a little bit of growth, or I need a little bit of cyclical push in my portfolio, these stocks can easily provide you some of that cyclical push because all of them have not been fully factored in. There's still a little bit of wall of worry that, hey, what if Ukraine-Russia situation is resolved suddenly and we end up landing in a spot where oil may take a beating, at least for now, for next couple of months, we won't have like a sudden crash of $30, $40 on the oil. We are in a peaking process, as we heard on the call from Steinbaumer, and then it would take its own pace or its own time in order for a commodity to crash. Also, the good news is commodities are the best ones to trade using signals. So if you understand the complete process, you would have a great time trading both the direct crude oil futures as well as trading the stocks which are associated to that. So moving on from crude oil, that was my point number one. Point number two is China. Rob, I think you made a great point a couple of weeks ago about China. It's trade and the trade level. Keith provided us with a very specific trade level when he was on the space. Um, we became trade bullish. Now we're trend bullish also. I'm long China through FXI as well as EWH and a little bit of ASHS. These are ETFs that I use for China. I don't have single name stocks just because I didn't have a great insight. Actually, I'll correct that. I do have one stock, which is direct stock NetEase. This is Felix Wang's one of the favorite longs, and from a tech perspective, I do understand their business quite well. NetEase is one of the stocks, in addition to the ETFs I mentioned. Amongst the countries I've been short on, Austria, which is EWO, hasn't worked out that well. I'm kind of down maybe a couple percentage points on that short. I'm also long Chile in LATAM. It's not a, it's purely a technical play, and there's no huge reason fundamentally to be long Chile, just pure technical play. Amongst the S&P 500 sectors, we have had energy and materials that showed massive leadership in the sector-weighted indices. You can notice that in the tweet storm that Chris had done earlier today. And then dollar has been doing quite well, also commodities. So my themes have been around commodities, slightly more international. Within domestic, it has been more energy and materials. Now, let me tell you what has not worked for me this week, right? I've had some, I had booked a bunch of profits in SAS shorts in the past. And when IGV got to the 295 level, I started getting some put verticals. These are at min to mid levels, haven't worked well. I'm also trying to express or build a short position for things such as Duolingo. But Duolingo, from the trade perspective, it's breaking trade on the short side, which means that I need to cut my losses and get out of it. I'll be observing it one more day tomorrow, and I'll be getting out of it. Similar to that, I've been noticing that several SaaS names, SaaS is software as a service, have been quite resilient, and that's why I'm thinking that on bunch of those on that basket, I might just cut my shorts at a minor loss before uh, re-entering them maybe at a later date when there's some when there's some supporting signal, because right now all the trade signals are showing to me that this trend is not that strong towards the downside, at least for those SaaS names. I do need to cut some of my uh, losses. Now, these are losses, of course, after a huge amount of profits I've got year to date on the same names and by expressing my short position. So I shared with you what has worked, what has not worked. I let Gavin speak about rates, and then I haven't had a chance to trade much of rates this week. Also, I'm looking forward uh, to the FOMC meeting. I don't expect rather massive volatility coming in before FOMC or leading up to FOMC. If anything, we might have somewhat of a suppressed volatility, so somewhere in this range of 24 to 28 or 30 region. I'm actually not expecting volatility to go past 30. But if it goes past 30, I know what to do. And then, as I expressed last time on the space, this is my last point about how I use the VIX curve in order to. I think Darren was with us, right? Was it last time, or maybe what was a different space or something? But we're
No,
talking
total
about
total was on. Yep.
yeah. So I mentioned about I'll tweet about the VIX central and how I use some of the VIX curve and the ratios between front month, back month, and for the 1 month back ratios in order to come up with some signals for risk on, risk off. So I'm yet to do that, but I'll definitely do that this weekend. Having said all of that, I'd mentioned about volatility being sold when we were at 31. On VIX as well as 3800, close to 3800 on the S&P 500, and we're experiencing that. We're getting this sudden burst because of wall targeting folks as well as certain insurance companies who are getting some interesting returns out of wall, suppressing wall kind of deals that they're doing. But having said that, so those are all my points I wanted to hit. Rob, back to you.
Yeah, appreciate it. It's a very solid overview, my man. I'm not sure how you have all the time of the day to cover those and do the day job, but very impressive as always. So thank you, Trent, for all your hard work and sharing that with us. Jimmy, over to you, my man, and then we'll kind of come back to Gavin.
Yeah, for sure. I had two questions to some of Trent's points. Great, awesome points, by the way. When oil hit that relative trough, what made you go max long versus engage in maybe some sort of narrative bias about demand destruction and the ultimate kind of plummeting of all assets in Quad 4?
Good point. So the immediate correction that had come from 120 to 110 was because of a specific inventory draw number or a specific macro number that comes out at that point of time. But at the same time, OVX, the oil volatility signal, had created similar kind of dynamic which we get when we used to do buy the dip last year in equities, right? So we had strong trade, strong trend, um, and strong tail. Um, I was just waiting for buy the dip sort of a situation. In the prior long that I had on crude oil futures, I was trail stopped out at approximately 117, and then I entered at about 112 again once it started resuming upturn. And that day itself, It went up like $4 or $5, and then it
Yeah.
kept moving up. And it also offered me opportunity or signals to jump on to things like Halliburton, HP, P10. All of these names had been buying in the money calls on the long side in order to load up the portfolio to a certain degree.
That's helpful. I mean, I think last
Yeah.
year when go ahead.
No, Jimmy, I was just to elaborate on that. So I was speaking with Chris this morning, and one of the things that he reminded me is that basically, from a trend following perspective or kind of a momentum trade per type, investment strategy, if it's got some momentum, so let's just call it 10 or 15-day momentum, right? If it has some momentum, then a position will be on, right? So let's just say it's, I don't know, 1%, right? So just to keep the math simple, as that volatility of the asset, comes out. So in oil, since we're talking about oil, we'll use OVX, right? Basically the position can get bigger as that volatility comes out because the relative kind of risk reward and basically you're for all intents and purposes, you're kind of beta adjusting that position, right? So all of a sudden, that 1% position with OVX moving again, let me pull it up. Sorry, OVX moving from kind of the 56 range about a month ago to now 44. That position size can go from 1% to 2%, or even from 1% to 4%, right? So
Yeah. I mean,
basically
my
taking
point
it,
exactly was this,
yeah,
but when I thought about the first dip, you remember like last year with volatility just being lower throughout quad two, OVX being sub 40. I remember like it was a 40 something number that again, it's not applicable in this regime, but the first time it went back to like 109, 110, it was still north of 50. It hadn't
hmm
gotten into the 40s now. Like definitely I see it's much more obvious now that there's some staying power to the price of oil with OVX coming down into the 40s. But I think that first time, again, I let a lot of the narrative bias overpower. Maybe there are other complementary signals that would have prompted someone like Trent, let's say, to back up the truck.
yeah, no, and if memory serves, I believe we're kind of moving down towards sort of the investable bucket on OVX
Mm-hmm.
according to like Keith's number. I
42 or
can't.
something like that.
Yeah, I
Yeah.
believe so, right? So it's getting close. Now again, there's all sorts of different components or influences, and one thing that I was going to get into, and might as well since we're talking about it, the OVX, and again, from a volatility standpoint, and if you're trying to navigate or review different the volatility for different underlying assets. The CBOE actually does provide some generic components, right? So, VIX APL, so VX APL, that would be the underlying volatility for Apple, VX AZN. And for many of you, you already know this, but if you don't, certainly write these down. You can review them on TradingView, which is where I typically pull them up. So VX AZN, VX GOG, that would be for Google. VX GDX, that's for the gold miners. GXGS, so George Stephen, that would be for Goldman Sachs. OVX is obviously oil. GVZ is for the gold underlying, which is down towards 16. And all these obviously these volatility, these underlying volatility components. And there's, many ways of basically tracking it and or creating your own, incorporating kind of historical vol along with realized vol. But these are like simple ways, again, that you can kind of quickly pull up as things are moving, right? So as RVX, which would be the Russell vol, or VIX itself, if you're kind of tracking that along with other components of price and volume. So for as a good example, right, for Amazon, we are short the consumer, so we're short XLY, we're short Amazon, we're short pretty much anything that has to deal with consumer discretion, retail, et cetera, et cetera. But if you kind of pull up the VXAZN, volatility for the last, even year to date, right? You can see most recently, that vol is now kind of hovering around 42 as of close today, and it's moved all the way down from closing range of, call it 58, down to 42, right? And it's making a new 10-day, 15-day, 1 month low. Now it's nowhere real close to the 3 month low, which would be closer to 32. But this is significant, right? So when you're kind of looking at your book, right? And we were having an initial move up, call it about a week and a half ago now, almost 2 weeks ago. As that volatility is adjusting and or sort of, maybe rolling over, you know, should give you a little bit of pause in terms of kind of getting aggressive on adding that Amazon short back on. Now, again, doesn't mean that you can't put it on, but you just got to be a bit more proactive in terms of managing that position, right? So, you might only be in it for a day or two, depending on what that volatility does. Now, it could be a massive head fake, like, Coach mentioned in the RTA earlier today about, Russell Vol and sort of, the bear market trend, or the big counter trend bounce in Russell itself and RVX, even though that did technically close below 30, so back in the chop bucket again today. But at the end of the day, the perspective is that this is, certainly on the Russell vol, is likely not going to last. So does VIX on the VXAZN, vol on Amazon, excuse me, does that stay down towards 42? Does that try to push down towards a 3-month low? I think that's really what trend was kind of getting to, right? Is this vol, and as you kind of get some of this higher volatility start to come out, right? So drift out of the look back. So I've mentioned this a couple of times in a number of tweets over the last few days, couple of weeks, as you kind of look at the look back, right? So like price doesn't have to do a whole lot. It just needs to move out in time. And so higher prices, or in this case, higher volatility, if that's starting to move out of the look back, then all of a sudden that top end of the quote unquote range, just automatically comes down. So it might move from, that high, as I mentioned on VXAZN, of kind of 58 in a couple of days. The 10-day look back is going to move down to, 52, right, from 56. And that's actually going to happen. Well, not tomorrow. It'll happen in about 4 trading days. So it's going to move down to about 52, which is where the current 10-day window is. That 10-day is going to start to drop down to closer to the 48 range. So again, this sort of like this pricing shift from a momentum standpoint just basically compresses that range. And that's really what, hopefully with this conversation, you're going to kind of go back and look at these charts and review them and see, okay, interesting. This is sort of what, was perhaps transpiring. We needed to be a bit more cautious, a bit more, just kind of be a bit more open to the idea that, we could go and push new 1-month lows. Now there are many other narrative driven reasons, but I prefer to just stick with what is and what the market's given you. Jimmy, go ahead, buddy.
Yeah, as a corollary to your talk about RVX, look at VXEEM, emerging market vol. I think China is a large component of that. That's down to like 24. And there are different periods in the year where that was in the 50s, then the 40s, then 35. So clearly there too, Trent made a couple points about China getting 1 month and even 3 month. Now, my question to you, I think, Trent, was like, does KWeb not look the same? I know those components have also done well. I think they fell further, and there are periods of divergence between the KBA, or let's say FXI, and KWeb, but obviously there's some good juice in the last couple of trading sessions.
Yeah, to answer your question, I was looking at KWeb, and from a standpoint between the two relative ones, right? So between FXI and KWeb, when I had to choose, I just wanted to get slightly more diversified China names. So didn't want to focus just on the tech side of it, but also China consumer side of it. So FXI was giving me that broader basket instead of just focusing on KWeb.
Got it.
That was my thought process. Doesn't mean, if you played KWeb, then, kudos, you probably made more returns, which is pretty awesome, right? Given 2022. But that was just my thought process to indulge in FXI and ASHS as compared to KWeb.
Okay, that's helpful. I'll just end the China discussion on my part with a funny story from Navy. So I'm sitting across the table earlier today with 2 like Asian REIT PMs, and I'm talking like, hey, anyone getting into China? Thinking maybe they knew passively or they had some interest. One, they had no idea. They're completely unfocused ex-US, and this is kind of on a personal level too. But I was surprised they didn't understand the charts from the last couple of years. China's been kind of crazy. And I was trying to explain 1 month price momentum. I was trying to explain that there was consolidation, that VIX had gone, the volatility had gone down. And they kind of looked at me and they were like, but what if it goes down? Like, how do I justify it fundamentally? I don't know how to control, my capital there. Again, a lot of narrative reasons. And I talked about a stop loss, but, we're still playing against people who are clueless. So there's an opportunity.
Yeah, yeah. Usually these kind of situations, and as you said, stop loss is the best way to manage risk. At least for me, I use stop loss. I know some folks don't use stop loss, but I definitely keep stop loss in play. If it happens overnight, it's a different story. The next day, my position gets completely washed out at a much deeper cut. But stop loss is the way.
Yeah, just on KWeb before we move over to Gavin. Sorry, buddy. In 4 trading days, that low end, that 3-month low that was, call it just north of 21, that drops out of the look back, right? So that all of a sudden, I think that's again one of the reasons that, to Jimmy's point, volatility is kind of perhaps coming out of some of China and emerging markets, because those volatile periods that we experienced kind of in Q1 are starting to kind of drop out of those look back, and it's the setup currently. Again, certainly wouldn't be chasing KWeb at 34 right now, but if it kind of retests any sort of trend line, so call it 3 month, or sorry, call it a 1 month kind of price momentum from just from a simplistic standpoint, right? That's definitely an area that if, with all else being equal, so call that currently around 29. That's an entry point that would be sort of interest as of today, June 8th at 9:04 p.m. So don't hold that to me in like 2 weeks.
I love that clarification.
Gavin, floor is yours, my friend.
Yeah, well, I'll just quick run down the asset classes real quick. I mean, U.S. equities.
Gavin, that's what we're here for. We got on a little bit of a vol tangent there. So
no, I think
this is what we're here for.
Yeah, he made really good points. U.S. equities bear market rally. I've been really quiet. Just kind of, I've not gotten a signal that I think it's over, but I think it's going to set up for a really good. Every day it persists. I think it just gets better on the short side too. But you just stay patient, and I'm not short the market right now. So I'll just wait and see. As far as the G20, you have China and Japan. I'm less interested in Japan, although, I am glad to see the yen come back on the short side against the long dollar. And for me, just the way I look at it, being short the yen is a better play than being long Japanese stocks for me. So, that's kind of how I'm expressing it. And then China, I think, is a really good point to bring up for people who might be new, especially. You hear, and you will hear, Hedjai and Keith talk about phase transitions. And every market is in a different spot. It's not all the same. And China, this I would consider a phase transition. And anytime you get a phase transition, which is maybe once or twice a year in a market, maybe once, for China, this is a pretty big deal. And so it should definitely get your attention. You don't have to worry about, you could, I know people are already long, and you could be playing it really tactically, but don't worry about missing the move. Because I would think probably in 1 to 3 weeks, you'll get a spot to, put on size in China if you want to actually play a 30 to 90 day move, that's what I do. I put capital to work in things that I think are going to trend intermediate term. That's what I try to do. So I think China is really interesting. There's a bunch of ETFs you can use to, and I'll kind of have a basket of different stuff. And so that's equities. Fixed income, obviously short, junk and high yield was a great opportunity that I know a lot of people took advantage of. In terms of U.S. Treasuries and globally as well, Really think hard about what's happening this week, because it's, I do think the turn is coming for fixed income, but I'm putting it more at like maybe the end of June, early July for a phase transition in yields. That's like what we're looking for, right? So for now, the best thing I can say about fixed income is, I'm short junk and high yield. Currencies, still long the dollar. I think it's finding its footing. I would expect the dollar to be strong still. And then, like I said, short yen coming back this week is kind of online after a little counter trend move is a welcome sight. Commodities, I'm long oil and natural gas. And the way I've been doing it with commodities is like just allocating a piece of the portfolio to like a basket of commodities. And so I'm getting ready to sell my oil. I haven't sold the last 2 days. But again, that's like a 30-day move captured. And so I'm getting ready to sell it, any day now. But, and then seeing what will work. Did I hit on everything? That's kind of the broad thing, the broad look. But I guess I would just say for new people, really pay attention to China just as a learning experience in terms of, watching a phase transition, like a market that's been bearish for a very long time and is starting to turn. Those are the best opportunities.
Yeah, 100%. And that patience is even more of a virtue on some of these turns, right? Especially with a market like China, where it's up 5-6% in a day, or down 5-6% in a day, right? So, completely agree there. I think that's a really good assessment and point.
I was also going to say, I forgot to say, a ticker that's interesting is right now that I quite like long in the fixed income space is the Simplify PFIX, PFIX. It looks interesting. Check it out. Look like it kind
stealing the
of.
words out of my mouth.
Oh, okay, cool. Yeah, well then you can run with it, but it looks like it's kind of completing a bullish consolidation here and might be ready to move higher. So I like that one.
It's right near what I would say it's trade line, excuse me. So it surpassed its trend, which is now, I got it closer to kind of 54. But this is an interesting spot. Certainly, if it kind of retests that 54 level, I'll be adding back to it. I had been, it was one that we've talked about many times on this call. I think even X2DA4, who's on here, he brought it to my attention certainly many months ago, many moons ago at this point, and it's been a great asset to have, as part of your fixed income basket. And it kind of definitely lost some signal strength there over the last, or sort of at the end of May. But it's to your point, Gavin, definitely recapturing strength and one that's on the short list. Oddly enough, preferreds PFF is the ticker that I use to express that in the portfolio. It's regained some pretty solid signal strength. So just wanted to throw that one out there as well. There's not a whole lot, in my humble opinion, in the fixed income side, unless you're, as you said, Gavin, kind of playing that longer term phase transition. I do think we're still a hair early here on that front, but the preferreds PFF is definitely one that is I'm actually long it. Not that we need to get into individual what we're doing individually, but yeah, it's been to me that's one that's looks a lot like the SPY, to be honest, in terms of probably signal strength and setup, but definitely obviously a lot less volatile than SPY. So I just want to throw that one out there too on the fixed income front. Mike T, I see you on. I did invite you to speak. I don't know if you're able to speak. If you can't, no problemo. But I did just want to give you the opportunity to kind of convey anything that was on your mind. Otherwise, now that we've been chit-chatting here and conveying what we're seeing in for terms of Gavin, Trent, and I, and Jimmy and I for the last 40 minutes or so. We can open the floor to some questions. I've got a few folks have DM'd me. I don't know if we're really going to be able to get into the intricacies of their questions tonight, but we'll certainly address them over the next week or so. So yes, I'll kind of open the floor. I see my boy Simon, the boy from Brazil, as well. So if he wants to convey anything that's transpiring down in EM land, I'm happy to. If you can, Simon, feel free to jump up. But I see Mike Taylor's here.
Oh, gents.
Oh, you doing, buddy?
Me. Hey, I'm sorry. I'm on an airplane right now, so it might be very loud. But here's the big news. The really, really big news is that Japan, the BOJ, is starting to take over.
Oh, we just got to the good part. We lost Michael
for a
second.
What a tease that Mike.
He's about to tell me something about my yen position. Mike T, what do you have for my yen position?
I'm sorry?
You cut out there, Mike.
Sorry, you cut out there. You said the BOJ. You said the BOJ, and then you cut out, buddy.
The BOJ is going to take over the Japanese economy. That's what's going on. I'm sorry if you can't hear me. I'll speak about it later. Thanks a lot, guys.
No, yeah. You got it, Mike. Thanks, buddy. What a little teaser. We'll have to do a circle up with Mike T.
I want to see if I can pull up his tweet, because he had referenced it a little bit earlier.
What he was suggesting was that, if you look at the pace at which the Japanese central bank, BOJ, is buying the bonds, the number of days in which they'll be owning the entire bond issuance is close to around 50 or 52 trading sessions. There's literally no other buyer in the market. So that has been like a big discussion point across many folks. And there's some sort of a challenge being thrown in the market that, okay, let's test the central bank. And that's what is going on right now.
So obviously that's good for short yen, right? Is it that simple?
Yeah.
All right.
I'm not short yen, but yes, if you're short yen,
you heard it from Trent's mouth, Gavin. He doesn't normally just declare yes very. He doesn't normally give you such a straightforward answer. So, Gavin, I feel pretty confident in that response.
If Chris were here, he would talk about yen to Bitcoin, because he had pointed that out before, how the chart looks different.
Yen till TOT. He was actually he had some good tweets. I think that was over the weekend. He mentioned kind of the Asian session and basically how Bitcoin has traded flat to slightly up during year to date in any of the Asian sessions, but it's during the U.S. session that it's massively basically in negative territory. So the U.S. Bitcoin owners are the ones that are not necessarily causing issues, but are certainly seem to be like it's in that session where the sellers
because they're holding the bag in a lot of other correlated assets domestically.
Yeah, I would think so, right, Jimmy? Anyway, but yeah, that's but it was a really cool Thousand Effects. If you don't follow him, he's kind of my partner for a reason. It's because he brings a lot of value and thinks about markets a bit, very interesting, very uniquely. So if you don't follow him, I'd highly recommend it. He doesn't tweet a ton, unlike my stupid self who sends you photos of my kids and stuff. But when he does send commentary out there, it's usually with a purpose or one to try to engage discussion and kind of thought around a different way of thinking about kind of a common either conception or a common just something that folks are kind of taking as salt, I guess. So anyway, a couple questions out there. And Simon from Brazil, what a pleasure to have you on. And George Syracuse, always thank you for tuning in and jumping up. But yeah, what question do you have? Or floor is yours, my man. And congrats on passing your CFP. You are on mute at the moment, George. We're not passing the CFP yet, but
who's up, me or Simon?
You are, George. You are.
Okay, so I have a question for not only Michael, but everybody else. So I'm kind of surprised that the dollar yen strength has not precipitated in more of a sell off in the United States Treasury market. So if anyone wants to comment on that, please do. That is something that I've gone very neutral on. I have to thank you, Robert, for PFIX.
Yep.
I'm running completely neutral in the treasuries markets because of what's going on with the dollar yen situation. One thing I will say that's encouraging is the fact that despite the dollar yen strength, bonds are not imploding. I don't want to read too much into it. I'll take it a day at a time and see where it goes. But, it is what it is. But very curious what Mike has to say with regards to the dollar yen and what he thinks interest rates are going to go to. Because we've had a very high correlation between stocks and bonds.
I know Taylor's still on here. I don't know how great his connection is going to be in the plane. So if there's anybody else out there that's kind of a bond or kind of has a thought or kind of lives in that land, please, by all means, please jump up and speak. And Mike Taylor, if you do want to take it and you are available, by all means, open up. But looks like we got Derb's coming up. So let's see what Derb's got. Hey, Derb. Hold on, you're connecting.
Yeah, hello.
Hi, Derb. Yep.
Hey, what's up, Robert?
I'm doing well. How are you?
I'm good. How are you?
I'm doing very well. Yep.
I should perhaps say hello to everyone else. And I am Derbney. I am a musician. I am here, for my music, but I have discovered Bitcoin along the way a couple of years ago, and it has changed everything. So
that's good. I thought you were jumping up to talk about bonds, so I'm gonna kind of mute you here for a minute.
Yeah, bonds. I mean, yes. It's like if we it's like, the way we think in bonds and shit. If you can switch that type of thinking, you can okay. I'm sorry.
So Derbney, I'm gonna
So
Derbney, I'm gonna cut you
yeah,
off, buddy. Yeah, I
yeah,
think
we have a
you
very
just
specific
kind of stumbled.
question.
You stumbled on a bit of a different space. So Bitcoin's not really. Again, we appreciate crypto as an asset and the commodity. But I'm just gonna kind of just pause you there, and I'll pass it back off to George. Maybe he's got a follow up.
Okay.
So the other thing I want to say is make sure you support Robert. That's all I have to say.
Thanks, Syracuse. Simon from Brazil, how you doing, my man? How's life down there?
Hi, Robert. Great to hear you. Can you hear me?
Yeah, absolutely. Thank you. Thanks for joining.
Okay. Well, thank you for doing this. It's fascinating. I don't often get to join live, so it's.
I know. I saw. Yes, exactly. We talked about this at Hedge Live. So for those that Hedge Live was a conference a couple of weeks ago. Simon flew up from Brazil. We got to meet there and chat in person, which was wonderful. And yeah, so it's great to have you on, my man. And don't let his British accent fool you. He really does live in Brazil.
Yeah, I do. So
what are your thoughts these days? What's jumping off the page to you? Because this Simon is another fellow, Hedgeye Jedi who dives deep into the notebook.
Yeah, it's been a bit. It's been a bit crazy here in Brazil. I can't speak to EM generally, okay, or even Latin America for that case. I can speak to Brazil a little bit though. So there are a few very country-specific things that I follow. One of them is the foreign funds inflow into the stock market on a daily basis, and also the foreign investor positioning on futures dollar contracts. So 50 to 60% of the stock market here in the financial markets are foreign investor flows. So what we've seen is from the first quarter we had something in the region of maybe $50 or $60 billion worth of inflow into the financial markets. That has dropped significantly, went negative a little bit, popped back up, and it's back down very low from maybe at some point $2 billion a day down to plus $140 million a day now. Dollar positioning here has switched dramatically from quite negative. They were expecting the real to appreciate against the dollar to positive now, so they're expecting the dollar to appreciate against the real. Now, one thing you need to bear in mind about Brazil at the moment is that they're coming into a presidential election space, so that's going to be coming up in October. And obviously with vote buying opportunities, reducing taxes, we have a legally mandated debt ceiling here. So as soon as that gets threatened, everything sort of goes pear-shaped. So stock market's down and dollar starts going up. And if you've seen over the past few days what's happened in Brazil, I don't know if many of you follow it, but the stock market's basically tanked over the past few days and the dollar's gone up dramatically. I mean, yesterday was amazing. I mean, it was up a hell of a lot because the government's now starting to make proposals to cap taxes on fuel, as are many other places around the world. But because of the legally mandated debt ceiling, this has rather larger repercussions, and it's frightening for international investors. Also, Brazil was sort of like playing a bit contra to the S&P 500 and the Nasdaq because
of oil, because of commodities.
Yeah, exactly. Because of commodities. I mean, Brazil is, 40% of the stock market is basically Vale and Petrobras. So it's iron ore mining and oil. But nevertheless, even though oil's been going up, Petrobras has had a hard time the past couple of days, and Vale's just come off a little bit of a peak as well, back up from 75 to 90 odd, but seems to be turning over slightly. How this is going to play out in the medium term is really, it's going to be difficult to say because of the political influence on the markets here. It's it's a degree higher in an emerging market than it is in a developed market. So oftentimes I've seen that there's been an RTA to go short EWZ, or as you might say EWZ, and it's not worked out necessarily very well. Because there are extraneous influences here that are difficult to take into account unless you've got your head in the numbers every day in the market. So I can sometimes see the way the dollar's flowing or the way that the funds are flowing into the market from foreign investors is maybe indicating sort of like contrary to what you might see from just looking at the risk range and a volatility number. But overall, I think it seems to be coming much closer back into line with the SPX. So the correlation here seems to be becoming much bigger than it has been over, let's say, the past 3 or 4 months. So that's it for me, really, from Brazil. Anybody got any questions, let me know. But thanks for having me on and giving me the opportunity to speak.
Absolutely awesome,
That's
Simon. No,
great
thank you for that. Yeah, I got a question just from a data standpoint. Is there an easy, quote unquote, easy way of tracking some of those fund flows you're talking about? Because I feel like that foreign investment would be obviously a good one to have on the kind of even the weekend review.
Yeah, what I'll do is if you want the foreign funds inflows, you've actually got to sign up to the local stock exchange system and pay a subscription fee and so on. But there are guys who tweet it out every day. Bear in mind that these numbers do come out with like a 2-day lag, all right, for the foreign funds inflows. But what I can do is I can tweet you the Twitter handle of the guy who publishes these every day.
Brilliant.
And the other ones,
I'll share it with the group. That'd be great.
Okay, and the other ones on the number of contracts that foreign investors have on the local stock market and in the dollars future contracts, that's updated on a daily basis, and I can send you the link to the local stock market website, and that's free information.
Brilliant, awesome, Simon. No, super helpful. Keeping us driven on the data, right, buddy? Appreciate it.
Always.
Always a pleasure, sir. Thank you again for your time.
Likewise.
And appreciate you jumping up to speak. David, welcome, my man.
Hey,
How
Robert,
are
how
you?
are you? Good. How are you
I'm
doing?
doing well, thank you. Yeah, good. Very well, very good. Thank you.
We've exchanged information or tweeted at each other a few times. I figured I'd hop on and say hello and thank you.
Yeah, absolutely. No, I was going to comment the same thing. You've been putting out some very high quality tweets yourself. So, so
Thank
thank
you.
you, buddy.
Absolutely.
What's on your mind tonight? What's in your notebook that's sort of
Well,
jumping out?
one thing I think you guys might find interesting, I interned at Hedgeye when I was at NYU in the summer of 2009 when it was in New Haven. So um, I got to work with Keith and Jonesy Buds back then. TJ was there, Brian was there, and that was super fun. That was an unbelievable experience when you're a college kid. Um, Worked.
That's really cool,
Yeah,
David.
yeah. I actually was at Bank Hapoalim, the Israeli bank in New York, when I was in college, and one of the directors of sales there wound up going to Hedgeye, and at the time it was Research Edge, and that's when I kind of met Keith and the whole crew, and it was really, I mean, it blew my mind at the time. I've kept a notebook almost every day since. So that was 2009, and back then Keith was all about the notebook. So it's amazing what's changed, but what's evolved. So that's kind of one of the things I just wanted to put out there. Um, I've also, just in terms of the PA and the long short, I do whip it around a lot. And I had tweeted, I don't know, a week and a half ago how short I was. I got to about 70%, 70% net short, mostly fixed income. I was very short JNK, HYG, some in the money puts, and those worked out well. I did trim them back recently. I've kind of tightened up my exposure. Like at these kind of times in this chop bucket, one of the things I've just been doing a lot of is tightening up my exposure. I don't need to be right every day. I don't need to have max positions on. I'm running a lot of minimum and medium positions right now. Um, just just wanted to put that. I don't know what people are seeing in terms of how much conviction they have, kind of getting up to their maxes, but across the board on equity longs and shorts, kind of running very very lean right now. I'm like 80% cash right now and pretty darn close to neutral on everything else. So I just wanted to put that out there.
No, David, it's actually a really excellent segue. So again, I appreciate you sharing your book. We don't always get into kind of the specifics of the books itself, but I think that the most telling aspect and kind of where I'd like to kind of take the conversation, if it's okay with you, is sort of what made you kind of make that pivot, right? So what did you see kind of on the page or in the charts or some of the stuff that you track that helped guide you? Because I think that's really kind of where I'd love to kind of take this kind of final portion of this call
Sure.
is to review kind of some of the things over the last 2 weeks when the week of Memorial Day week, we kind of had a session, right? We talked about kind of, shorting
Yep.
and sort of, some folks had gotten kind of a little bit bigger, size a little bit bigger than I certainly was from what I was seeing. And David, just to be, I'm in a very similar boat, right? In terms of being neutral, a lot of cash on hand right now. I did, again, I kind of whipped it around last week and got longer for a trade, right? Took my 3%, quote unquote, quote unquote 3%, and took my ball and went home, right?
Right.
So,
Exactly.
I missed some of that other move, but until I see another signal that sort of tells me that we could have another leg higher here, I'm going to be kind of sitting to, and that's just Gavin likes to have the setup for that sort of 1 to 3 month standpoint. I just like to have a bit more of a clear signal. Like on last week's call, on this call, I called the markets opaque.
Yep.
They
Exactly.
absolutely were opaque in my humble opinion last Wednesday. They got a little bit clearer this week, and I think that's one of the reasons why Keith, sent that signal out on the Russell.
and or yesterday, right? And kind of wrote that early look this morning, kind of walking everybody through that. I do humbly do think that they're getting a little bit clearer, but maybe not in the direction that people really want to hear, right? And, I'm not saying that quad 4 is not on the horizon, and that that we're not going to get short again, or that the short book is the right way to go. But I'm personally kind of waiting for things to kind of give me a bit more of a clear direction, because right now the top end of the vol risk range, so call it VIX, right? As of this morning, it was 30.441.
Right.
So that's barely in that F bucket. And I know Coach talked about this all day today, right? Across multiple facets. But when we're just kind of definitively or relatively definitively in the chop bucket, that's where, one, you got to be very comfortable with just being in and out of a trade and not really holding it. And if that's not your game, then there's nothing wrong with sitting on the sidelines and going to the park with your grandkids or your kids, or playing a board game. I did that for about 4 hours today, to be perfectly frank with everyone. I played out Fox the Fox at around 3 p.m. with the kiddos, and then we went to the playground on the splash pad. So it was then we made pizza when we got back. It was it was an okay day, and I didn't make a single trade going into the close. Now, is that the right move? Maybe not, but that's just how I approached it today. So anyway, Dave, I'll kind of pass back to you in terms of what you saw in the setup over the last couple of weeks, and maybe that can help folks, with what in their notebook, what they're tracking, that kind of thing.
Sure. No, that's great. And I think that one of the things I've always tried to get a bigger helping of, whether we're in a bull market, a bear market, any one of the three vol regimes, is patience. I'm just trying to constantly get more patient. And when I say patient, kind of waiting for clearer signals, right? Rather than always wanting to operate in the middle of risk ranges. You can save yourself a lot of heartache, especially in the chop bucket. I would, from what I've seen, by operating anything other than kind of more of the extreme levels. On one hand, I understand, I think, pretty well the shoes to drop, the quads, and the GIP model kind of throughout the end of the year. But as Mike Taylor always says, don't be right, make money, right? It's not an academic pursuit. At the end of the day, your P&L is the score. So yeah, when we're in this kind of chop bucket, I'm in and out of things a lot quicker. When I do have profits, I take them quicker, long and short side. I do tend to operate even more in the chop bucket at the extremes rather than kind of in the middle. So today I think I placed one or two trades, and that was kind of it. And it was, quite frankly, on the short side of a fixed income, and they were very small trades, just kind of touching positions. So the volatility regime kind of dictates a lot of what I do, and I'm doing what the vol's doing. So when we're in this chop bucket, I take it right down. Right, if I see volatility spending a lot of time in the 30s, and it slices through it like a hot knife through butter. I mean, I'm taking down my shorts to min. So I run with usually 50 or 60 short positions in equities in a quad 4, and I have half that many, and they're all at like super, super, super small positions. Carvana was a great example. I know Mike Taylor was touting that publicly, 200% higher than where it is now. And you had something like Lovesac down over 20% today, and it finished down 5%. When you get a 20% gain on the short side in the chop bucket, you probably want to take that in the morning. So that's what I'm doing. I take my profits a lot quicker.
Yeah, it was like, I think on what day are we? We're Wednesday, I think. On what? I think Monday.
Yeah.
It might have been yesterday. S-Fix, like Stitch Fix.
Yeah.
That thing was down like 9% at one point.
You
I was like, "Yep, thank
you
you,
take
thank you very
those.
much."
You
But
take
yeah,
those. Yeah.
yeah, you take it,
You
right?
got to
You
pay
say
yourself.
thank you,
You got to pay yourself.
and or put that stop, that trailing stop a lot closer to where it's trading, so that you don't, so you don't lose money on that trade. But I mean, not everybody can kind of trade like that, David. So but it because we've got IAs on here, we've got RIAs across the board. You got Turtle, George, I mean, and Syracuse, as well as Syracuse, and many others that listen in. So, but with that in mind, I think the core takeaway is patience, right? Is
Absolutely.
patience and letting the setup really gain a little bit of steam. So let that VIX, or let that volatility. So what I'll be looking for, and Gavin, this is something that I think you can speak to as well, and I think you got your hand up here as well. But what I'll be looking for in terms of kind of getting more aggressive on the short side is looking for that VIX to kind of make a bit of a day-over-day higher high, as well as, more importantly, a week over week. So today is 30.41. If that turns into,
To add
if
something
that,
here.
yeah, go ahead.
Yeah, so what I wanted to add was, in the tweetness, have shared one tweet about the VIX futures forward curve, right? What it maps is what your VIX futures forward curve looks like when you connect the dots between your 30-day out, 60-day out, 90-day out, 120-day out futures. Now, you asked specifically about how in May end, what were the signals by which one would get off the heavy short side, right? And one of them was, obviously, we hit that exhaustion when that snap thing came out. I think that was 23rd May. You take your profits at that time and run. But after that, do you want to prevail on your short side, or do you want to add to new shorts when stocks were going up? Was a function of that VIX curve. So just to illustrate a point, in the last 3 days, if you look at the tweet in the tweetness, the curve has come down. And if you go to VIX Central under the historical prices tab, you can actually hit previous state button and get literally the May 26 VIX curve. So the May 26 VIX curve was above all of these curves, which you could see for each one of the days. So just to keep the audience with me, each one of the lines in that picture is showing the curve for that day. And as you move along to previous day, that curve moves along. As the curve goes, um, you know, if you're having that curve moving below and below and below, so you're not just watching the VIX in the front month, you're also watching its linkage to the back months, right? So when it goes from contango to backwardation and other way, you're seeing those steps, and that would act similarly to, how you mentioned earlier, that when the wall comes off and you have trade, trend, and tail, all three lined up for you, you increase your size. So similarly over here, if you are short, but the VIX curve, the forward futures curve, is moving down, then you have to get out of your short positions, because you're going to face a massive bear rally as that keeps happening, because that doesn't happen in a day. If you trace back from May 26th all the way to June 8th, which is today, you'll find that there was a pretty decent step by step depletion, and not just of the front month, but also the back month. It was also signaled by the ratios of the VIX front month to second, second to third. There's specific criterion in that which help you determine, and this is how CTS tackle this professionally, right? When they are trying to manage their book extremely tightly. So from a pure day-to-day basis, if you want to go in and out quickly, you definitely want to monitor the VIX futures curve and its relation to how it was the previous day, and its relation to the other points in the curve. If anyone wants to ask me anything, I'm open, but that's absolutely important to understand how that VIX futures curve operates in order to have a good positioning. George, I think you have your hand up.
Well, I think he saw Nancy Davis out there. He's going to
Yeah.
re-ask. He's going to re-ask his bond question.
Can you hear me?
Yeah, Syracuse, the floor is yours, man.
So I will ask two questions because I was actually raising my hand before she came in.
Fortuitous
re-ask the
timing, though,
bond
Nancy.
question.
So thank you for jumping up.
Well, Nancy, what do you think with the MOVE index moving the way it has? And I would have suspected that the bond market would have performed much worse with the dollar appreciating so much against the yen. So that's question one for Nancy. Question two for the community is, what are people thinking with regards to China, Asia? I personally think China going from bearish trade to bullish trade, while not yet getting bullish trend, is a bit of a trap. That's my personal opinion. It's not investment advice. I legit think it's a trap. But I'm curious what other people think about China and Asia, and I'm curious what Nancy thinks about what's going on in the bond market.
Yeah, Nancy, if you're able, we'd love for you to take that question about the bonds and welcome. Thanks for jumping in. What a pleasure to have you on again. So thank you very much.
Oh, thanks for having me. I really appreciate it. It's all the things I love talking about: bonds, volatility. It's like, oh, I can't resist. I'm like, what better do I have to do at
No, it's the
9:42
best.
on a
On a Wednesday night, right? Yeah,
after a
exactly.
margarita, I would add. But yeah, I've been in
That's
a
even
Mexican
better.
restaurant.
That's even better. So for
yeah,
those that
no,
aren't, so Nancy, just give me 30 seconds. For those that aren't aware, and I'm sure many of you are, but Nancy Davis runs the iVol ETF, so that's IVOL, and she's got basically more knowledge about bonds and derivatives than I'd say most of the human race combined. So with Nancy, I'll pass that off to you, and you can lead the charge on George's question, because which he asked earlier, but none of us were savvy enough to actually even attempt to give a response. So Nancy, the floor is yours.
Well, no, I think George's question is spot on, and it's all, everything is so connected, and it's all about the cross currency basis and the difference with rates around the whole world, and the U.S. dollar bond market. I think the one thing I would say about the MOVE index is the MOVE index only looks at treasury volatility. So in order to have an index, it has to suck in a price, and it needs basically a futures market to be able to consume the price. So it's not actually, that's treasury bonds, but it's not the rates market per se. The rates market is, I would say you could look at, like, for those of you with the Bloomberg, you could type in USSN 0110 currency go, and that will bring up, the 1 year, 10-year swaption vol. And you can see that, over the course of this year, it's a little bit higher. But it's actually come down substantially since the Japanese fiscal year end. So vol just started to pick up a little bit more today, but it really has been depressed since where we were at around quarter end, and in April it spiked up a lot more. And so the way to read that vol, there's, I know the VIX gets a lot of attention because it's indexable and everybody can look at it, but anything that has an options market has a vol market. So there are lots of different types of volatility. VIX is just S&P vol, and it's just short dated S&P vol. So like there's really no index for the rates market volatility, but I think that is the more relevant. They're typically on top of each other, but not always, because that captures the global community, right? That captures, every single sovereign in the world, every single global corporate, when they issue bonds in dollars, which, like, everybody's selling us their bonds, whether it's the Kingdom of Saudi Arabia or, Sony. They use the swaps market to hedge. And so that vol, the way to interpret it is it's traded in normal vol, whereas like the VIX is traded in log normal vol. So the way you have to, they're not really apples to apples, because interest rates can go below zero, as we've seen in the past, and they are for many different developed markets around the world. So like for instance, right now the 1-year, 10-year swaption vol, and stop me if this is like too much TMI and too much information. Should I keep going with this or?
Nancy, unlike other spaces, we are following
Keep
you
going.
loud and clear, baby.
Okay, cool.
This is awesome. The fact that I was just thinking to myself, one of my good friends, Chris Moyer, who I believe you met at Hedge Eye Live, he's going to geek out about this tomorrow morning when he listens to it on walking his dog in the UK. So this is going to be awesome. Log vol, oh yeah, baby. This is
yeah, with a margarita, by the way. So,
I love it.
Forgive me.
I've got the polar seltzer here, but I feel like I need to join you with. There's a margarita in the fridge I could go get.
I've been at a Mexican restaurant tonight, but anyway, so swaption vol, right now, if you look at it in the level in Bloomberg, it's 100.53, and the way to kind of compare that is the normal vol, and so the way to it's basically you have to divide it by the square root of 252, which is approximately just call it 16 for back of the envelope math. So that is the basis points per day that you need to break even on that vol. So basically,
And just for the audience, sorry, Nancy, I didn't want to disturb, but just for the audience, the 252 comes from 252 trading days for the year.
Yes, thank you. So that's just a way to look at what is the move, so to speak, that's been priced into the market. So basically, any daily change or annual change, that's what the market's pricing in. I did a tweet about, I'm new to Twitter, I've been on for about a month, but I did a tweet about normal versus log normal vol the other day, just trying to explain it, because they're not apples to oranges. And it's definitely, I personally think the rates market the vol is probably going to continue to go up because we just started the balance sheet unwind. And I think especially with the mortgage market, as the Fed unwinds, because we've had higher overall, expectations for policy rates, there's a lot less prepayments going on. So the Fed has come out with their caps about what they're going to reduce the balance sheet with, but with less prepayments happening in the mortgage market, that could potentially mean, to meet the caps, that they might actually have to sell bonds to meet the caps. Now, that won't be the case in the treasury market because you don't have that embedded short convexity like you do in mortgages, because you very simply, if you think about what a mortgage is, like a homeowner, U.S. homeowners are long the option to prepay. Therefore, the owner of the financial mortgage is short an option to the homeowner. And whenever you're short options, you're short vol. It doesn't matter if it's call or a put or a payer receiver swaption or payer swaption. You basically, anytime you're long an option, you're long vol. Anytime you're short an option, you're short vol. So hopefully that's a little helpful just to demystify. And the question about the dollar, yeah, I agree with you, George. I think it's a little, maybe it's like there's no good alternative right now because central banks around the world are getting more kind of hawked up in the developed markets.
George, it sounded like you might have been driving, but did you have any follow-up, bud?
No, I didn't. I'm just kind of looking at. We're going into a big.
I feel like we got to digest this and then follow up with Nancy tomorrow and be like, "Okay, Nancy, we have follow-up questions."
Yeah. I mean, we have Friday CPI. We have Friday CPI. I personally think we're going to come in lower year over year, but it'd be very unimpressive. That's my personal opinion, not investment advice. And also, there's no good news. So, and then next week we have OPEX. So, I'm not a bull. I'll just put it that way. I'll shut up.
Yeah, it's very serious. So Nancy, in terms of the vol products that are available out there to help navigate, what you just spoke about. Again, I know you've got your eyeball, but would you consider creating something that might trade more in line with that vol product, basically in line with the vol product you were mentioning? Because it sounds like it would be a really good hedge for many who have fixed income exposure beyond just the move, which, as you said, as you mentioned, was purely focused on the treasuries, and having something that's a bit more fixed income oriented from a volatility standpoint.
Yeah, so there are a couple of ways to access U.S. dollar interest rate vol. I would say I kind of bucket it into four buckets. One is for people who don't have ISDA agreements, and you can, there are ETFs that access the rate volatility markets. Both of our funds are long fixed income volatility. There are four types of volatility in the U.S. rates market. So you can look at the euro dollar market, which is a listed market that trades on the CME. There are listed options out there. The problem with them is they don't go out super long dated. So it's more, gamma exposure, less vega exposure, because they just don't trade that long dated. You can use treasury options, which is what the move is based off of. But a lot of the rates market doesn't, most of it trades in the swaption market, which is a lot bigger, which is that code I just described. And then there's curve volatility, which is what we own inside of, Quadratics ETFs. We own curve volatility, which is like a different type of volatility. It's more about the spread between short and long dated rates widening and moving. So it's less of a directional bet on, you necessarily not saying like where you think interest rates are going to go. It's more of a directional bet, like credit. Credit has exposure to, if you're long, investment grade or high yield bond, you want credit spreads tighter and yields lower because it's a bond. For us, we want interest rate spreads wider for IVOL, for instance, and that it doesn't matter if, the level of the policy rates or the 10-year. It doesn't matter if it's like, 1 or 5 or 15 or negative 15. It's just about the spread. So hopefully that's helpful. But there are four main types of U.S. Rate volatility out there. All are different. At the end of the day, kind of all volatility becomes correlated in periods of risk off. So vols across asset classes, whether it's, dollar yen or, Saudi rate vol, like US rate vol, kind of things kind of in a panic all go up together. But personally, I think with the Fed unwinding the balance sheet, it's a pretty good opportunity to be looking at US rate vol, because I think, as they unwind and let the roll off happen from the mortgage market, which is embedded short volatility, as well as, letting the treasuries roll off, I think that'll probably continue to think about it, like the big buyer is not there anymore. Somebody really has to step in. So it's I think it's a good time to diversify away from credit and mortgages because of the odds of them underperforming with quantitative tightening, and potentially, like, if we do have a recession, is pretty high. So if you're going to have corporate risk, it's probably better to use that, corporate bullet, so to speak, with your equity exposure, rather than, think about very simple example. If you own, Microsoft stock, just to pick a stock, in Microsoft bonds, you don't really have any beta that's different to each other. You just own a different part of the capital structure. So again, I'm not trying to give financial advice, but my personal view is just, I think it's a time to really be diversifying away from credit, especially with all the supply chain disruptions, and that's all just been exacerbated with the war in Ukraine and zero COVID policies around the world. It's like it's a tricky time to be an investor, and looking for diversification is really, really important. And there are things other than the VIX. The VIX is not bad, but it's just a sliver of volatility markets.
Yeah, phenomenal points. And we've talked a lot on this call, and many within Hedge Nation, in terms of junk and HYG. But if you're looking for another fixed income component, that what's the polite way of saying looks like garbage, would be MBB. So if you can short, if you have the ability to short, that MBS basically ETF. That thing just put in a new 1 month low and does not look very attractive at this moment in time. So definitely put that on your short list if you're looking for some fixed income exposure to diversify, especially as Coach is kind of pivoting towards. Again, he kind of made the move today that with the potentially hawkish CPI print that's coming on Friday, but yeah, so just put that one on your pin sheet. I've got a couple. George, you got another follow-up question? Yeah, sorry.
Yeah,
Yeah,
MSC,
I got a
did you have a
follow up.
Sorry, MSC, I'll be to you right next, okay, buddy?
sure.
Yeah, so I got a follow up. I agree with Nancy with regards to again, nothing I say is investment advice, but I cut a lot of mortgage exposure, corporates, investment grade. There's a lot of potential fallen angels. So completely agree. If she has anything to say about, you know, could we see a crisis related to Japan and what they're doing with the, yield curve control they're doing, I'd love to hear that. If she's got nothing, then that's cool because we don't know what is going to happen, and I respect that. And then my other question is actually for Jimmy, and what he thinks about Ouster. If he has anything to add there, and I'll let other people talk. I'm done for the night. I'm just going to listen. But make sure you support Robert.
Thanks. Thanks, Jerry Gibbs. Nancy, do you have any commentary on the Japan? It's a bit narrative driven, but I'll allow it for tonight.
Cool. Yeah, just a quick comment on that is the RBA also was doing yield curve control. It was a slightly obviously it's a curve, so there are a lot of different points in the curve. Japan has been kind of fixated on the 10-year point. In Australia, they were fixing the front end, and Lael Brainerd actually, if you guys remember when we were having like the last repo crisis that was pre-pandemic, it was in the fall of 2019, she actually kind of put out on the table having front-dated yield curve control to potentially keep, the repo markets are kind of the lifeblood of our financial system. And when repo rates were hitting 6 and 8% overnight, when policy rates were zero, is a very unhealthy sign for the market. It's kind of like the grease of the wheel. And so I think big picture, like there are a lot of different types of yield curve control. Australia did lose control of their, and then they abandoned it. So I would say, is it going to be a blow up? Like, yeah, I think probably some people could get pretty hurt based on positioning and stop outs, but I don't think it would topple the apple cart necessarily. Japan's got a whole lot of other issues, but I just given that Australia is kind of broke, I don't think it would be like a super disaster. Although they should probably really abandon that. It seems like one of those things where you keep it's like you keep touching something hot over and over again and just burning yourself over and over, and you keep doing it. Like it's not working, right? I'm sorry. Why do they keep doing it?
The cast iron pan does get hot when it's on the stove, right? Like it's
yeah. So keep rubbing it.
Yeah, exactly. No, it's good points. Jimmy, if you don't mind, I'm going to come back to you on that because I think MMC's got a question more so for Nancy Davis, I believe. But
yeah, I appreciate that, Robert. Thanks for your tweets and everything that you do for the community. So,
absolutely.
Nancy, I just had a question for you. So, do you have any thoughts or observations about the recent move that we've seen in the VVIX and the volatility, and how that might relate to the recent moves in the equity markets? And do you have any thoughts more generally on the volatility? And then the second question I had was just munis in general, your thoughts around munis. And, I think you talked a little bit about moving up the capital structure, maybe finding, some bonds of higher quality, moving away from corporates, finding treasuries and maybe some other things. And just some thoughts on munis and your observations around that. Thank you.
So regarding munis, like I'm definitely not a muni expert. I kind of feel like big picture, it's really just a tax avoidance scheme. And you are taking credit risk. Like I don't, you know, I'm not predicting like the muni market's going to blow up, but I think just like anything else, you want to have diversified risk, and especially, you know, having it super concentrated in one state or another. Like you can look at what happened in Puerto Rico. You just want to be diversified and don't want to have all your fixed income in one bucket. And there are a lot of different types of fixed income, but I think it boils down to there's two types of risks in the fixed income market. There's either rate risk, which gets a lot of attention these days with people saying, oh, I want shorter duration or I want longer duration, where they tweak the amount of DBO1, which is basically the delta sensitivity to a 1 basis point change in interest rates, or they take a lot of spread risk. And spread risk is everything from, whether it's muni credit spread, high yield, investment grade, distress, levered loans, floating rate notes, like anything that has spread risk, which is above, governments. And so I think it's just important when you're looking at portfolios, like you don't want to have, don't just go on, oh, it's short duration, it's safe. If you look at some short duration strategies have a lot of structured credit inside them. So just be careful about actually understanding what you own, and just it's really a time for diversification and a lot of different things. Like you can't be, you don't want to say like one asset class is bad, but you just don't want to have all your chips on one thing. And then going back to Vol, like, yeah, it's definitely creeping higher. There is a lot of, so many models have been going towards trend following these days too. I would think like even like some of these tax lossing, index strategies where they're doing customized indices, which is all about tax harvesting every single day. So when something is down on the day, there's kind of added pressure to go down more. And then when something's, it's kind of like, I definitely think there's so much allocation, especially on the institutional side, to private strategies, whether it's private equity, private credit, direct lending, things that don't have liquidity, that public markets are going to be, for me, I run long volatility strategies. So I would say beneficiary, but for most regular people, I would say, the burden is going to be on the public markets to move, and have these be the funding sources, because there's no other funding sources on the private side because the capital is locked up for so long.
Awesome stuff, Nancy. Thank you very much. A couple others jumped up here. So Paul and Keegan, do you guys have questions for Nancy or other subject matter?
Yeah, thank you.
Yeah, of course, Paul. Yeah, of course. Hey, Paul.
Oh,
hey,
great. Yeah,
Robert, thanks for bringing me up.
Thanks for
Yeah,
having the
no worries,
forum.
Darren.
So Nancy, kind of a broader question. Really appreciate all the commentary and the diversification advice. When you think about, you mentioned before, we're missing the bigger buyers. Is there something like, down the line, like maybe several years from now, or maybe even shorter term, where you feel that the Fed could kind of quote lose control of the yield curve? Is that part of the probability of, say, if you're building bond ladders, going out 10, 15 years, is that part of like a real risk, or is that something that you feel would really be kind of an Armageddon situation where it's most likely not going to happen?
Well, I mean, if we just take a step back and be like, all right, what is the yield curve? All central banks around the world set the policy rate, and the term structure of interest rates, meaning interest rates at different maturities, is really set by the market. And if you very simply try to break down, like, what does that mean? A simple example would be like if you went to a bank and you opened up a CD and they said, okay, there's a 3-month CD, there's a 6-month CD, there's a 3-year CD, there's a 10-year CD. Generally, most people expect to get paid more to lock up their capital for longer. right now, the Treasury curve is not inverted, but the swap curve is inverted. You can pull that up on your Bloomberg screen by typing USSW's 2s 10s, and you can see that the swap curve is actually negative, and the forward yield curve, which is, the future, there's no futures market here because it's not listed. So the future forward, really the same word, it's just a different jargon term. So the forward curve, which is where it is in the future, is actually really negative. And that's pricing in, that basically longer term yields are trading at a lower level than shorter term yields. So basically, the market is saying the Fed is going to hike rates, and it's going to create this, disinflationary low growth environment. So I think the concern, I think, would probably be like when the yield curve inverts, like the Treasury curve. Everybody was talking about, oh, recession, policy mistake. It's all over the media because there's so many studies about, which comes first, chicken or egg, the inverted yield curve or the recession. So I don't think the Fed's really going to want to invert the yield curve any more than it already is, because it already is inverted. They've even put out a white paper, one of the, I forget which Fed it was, but saying, oh, don't look at the, 2s 10s, look at the 3-month 10-year, which is not inverted because it doesn't have the Fed hikes in it. And I think that's really, at the end of the day, like, what does it mean if you have an inverted yield curve that doesn't allow capital to get out of the financial / banking / Wall Street into Main Street? Because lenders typically will not lend longer term and get paid less. So I don't think the Fed really wants the yield curve to invert. It actually is inverted right now, especially in the forward space. And there's been a lot of chatter from the Fed about it. But I think that's where yield curve control could really come in if they try to control the front end, if people expect more rate hikes than what the Fed actually prices in. Because remember, they've only hiked 75 basis points, but the forward curve has moved so much with forward guidance. So the Fed has to hike an additional, like, I'm just looking at if you pull up Fed Fund Futures, you can see the number of hikes. So just this year alone, so in 2022, if you look at Fed Fund Futures, you can see the market is expecting the Fed to hike 191 basis points more this year alone. Like, we don't even have 6 months left in the year, and we have midterms. So, obviously it's impossible to predict what policymakers do, but I do think the balance sheet reduction, the quantitative tightening, is a nice way for them to really control the yield curve in a little bit more and make it a little bit more healthy, right? A healthy upward sloping yield curve is a generally good thing for the economy, because it, unlike what Japan's doing, which is kind of goofy, because it's basically just encouraging people to own JGBs and, like, stick them under the bed and do nothing. But a healthy upward sloping yield curve encourages, more lending and more transmission of capital from Wall Street to Main Street.
Great. That's really helpful. So it sounds like the bigger risk is the inversions, the deeper inversions, not so much that, eventually they won't find a buyer, because in fact they are making the balance sheet healthier with QT.
Yeah, the balance sheet unwind, I think, should probably steepen the yield curve, because it allows, the market to move in a more normal fashion. And right now, it's not normal because it's actually inverted in the swap space.
Great. Thanks a lot, guys.
Yeah, that makes sense. And just along those lines, so a gentleman out in the crowd, George Sakis from Montreal. So Nancy, he kind of pinged me, and he the commentary. I mean, what I just heard from you, and this was kind of before you spoke, but basically, it sounds like, again, it's not your opinion, but what your quasi expectation or what have you would be, that the Fed will lean heavier on the QT side, again, the balance sheet shored up, while raising rates incrementally here over maybe the next couple months, and then kind of see where the kind of bond market
sits at that point, right? Kind of going into call it Q4.
Yeah, no, it's hard to predict exactly
I know,
what
yeah, like
policymakers are going to
I know
do, but
100%, but
yeah,
sorry, yes.
said another way, like there's, you can see in Fed Fund futures, there's 191.5 basis points of hikes priced in 2002. So if they don't hike, you think about that, even if they do 50, 50, 50, almost another 50, like 4 times in a row, that will just meet expectations. So if they hike, say 50 basis points, another 50 basis points, and then maybe they do more balance sheet reduction, that should, and there are even more hikes priced in for 23. You can pull that up. You can see, I see 43.5 basis points of hikes priced in addition to, and that's not including the 75 basis points that they've already done. That's in addition. So it's like, it's a lot of, I'd say, padding, because the Fed has just been using their words, right? This is all just forward guidance. They haven't actually done these hikes yet. So it's really, I think it's smart of them. Like, it's kind of like a free option. Like, why not talk really tough and be really hawkish? Because if for some reason, like something, whatever, geopolitical or markets or whatever, they can always ease off. So I think they've been, I like to call it talking cheap, to talk really tough. But I think the balance sheet is going to be the ultimate way that they, try to really control the money supply. And the Fed's balance sheet is almost, it's not quite $9 trillion, but there's a lot to go. And I think it probably will mean a lot more fixed income volatility in particular, because the last time they tried to unwind the balance sheet, it didn't go so well. So now they have caps, but with interest rate higher, the prepayments are down. So that might actually mean selling mortgages. So I personally would be careful to look into, even if you have like a passive fixed income fund, like the ag index, for instance. It used to be the Lehman ag, and then it became the Barclays ag, and now it's called the Bloomberg ag. The ag, that a lot of people own for core fixed income, about a third of it is mortgages. So just be careful to actually dig in to see what you actually own, and just make sure that you're comfortable with those risks. Just don't go by name only.
Yeah, it's a great point, a huge point actually, and to kind of dive under the hood. We've talked about this many times on this call in terms of, XLE is a great example in terms of, and even, stuff like communications like XLC, right? It's basically Facebook and Google make up a huge chunk of that ETF. I think it's something combined. It's like 48% or 46%. So it's like a huge component. And you're basically XLC. You would think you're getting much more diversification, to your point, Nancy, but you're really just getting exposure to Facebook and Google. And for AGG, yeah, it's a good segue into the munis. For those that have access to, like, I know many here, subscribe to Hedgeye, blah blah blah. But on in their macro themes deck, slide 55 kind of starts going into exactly what Nancy was just referring to, especially what it looks like from expectations, as well as the combined kind of equivalent rates in terms of what QT as well as raising rates would look like. So go take a look at that slide deck. But got a couple other questions, and then probably going to wrap up here. We're kind of pushing 2 hours, so yeah. Keegan, did you have a comment?
Yeah, a question for Nancy.
Yeah, by all means.
Yeah, given the dynamics of the Fed and the bond market, you kind of got the tail wagging the dog. Is there any evidence that the bond market vigilantes are back? Are there any data points that suggest that? Because that would open up some runway for the Fed for sure.
Could you define bond vigilantes? What does that mean?
Well, yeah, just people pressing the yield up further and further, and for this steepening, as you're referring to. I mean, that as I've been watching the bond market over the last few months, it definitely seems that they're leaning on the Fed, like at certain opportunities for sure. I mean, is that something that you're seeing as well? Are there any dynamics to the yield increases that are kind of pressing that further and further?
Nancy. Let me bail you out on this one, Nancy. for those visual learners out there, I put the swap curve that's inverted at the top here in the nest, and also that Hedgeye slide deck would be great resource to be able to see some of these fixed income dynamics. But in terms of those bond vigilantes that you're talking about, right? I mean, for me, ultimately, the reason why yields rise is because you're not finding any sufficient buyers to be able to satisfy the supply that you have of treasuries, right? And for me, over the last 2 years, you've really had to twist my arm to buy a fixed income security. And ultimately, if there's more sellers than buyers, you'll see those yields go up.
Yeah, follow up real quick is that part I fully understood. I guess the question is with the amount of QT that's going to be flooded into the marketplace, it would seem that really is going to tighten, right? Therefore, it's even more likely that there'll be less buyers.
So when you say a QT flooding into the market, what do you mean, right?
Well, just the rolling off and or selling off of debt.
Well, they're not actively selling, right? So I can put up into the nest what Fed commentary is on how they're approaching the quantitative tightening and schedule. But essentially, right now, they're just letting the treasuries mature, right? And then they're not issuing. They're capping the net new issuance on a month-to-month basis. So they're not actively selling. So that's I think a key point, right? So it's more advantageous to be aware of what the term and maturity structure is of different treasuries, because that amount is just not getting put back into liquidity provisions that corporate parties, counterparties are going to be using in the future, right? So it's not like an active fire sale. So it's not like I think that this is the catalyst for some extreme event one way or the other, right? This has been, the Fed, right, as Nancy has said, has been really talking very, very tough. But they should be, because they're so far behind the curve. And so we're still at the very beginning stages of all of this. We're still at the very beginning of rate hikes. We're still we're only like 9 days into this quantitative tightening. So in order to see the effects of this, throughout the market, it's going to take time. It's not like this is something instantaneous that is going to just make yields rise, immediately right after this happens.
Gotcha. Yeah, no, I understand. And I believe they're doing it in phases right over the following 3 months, where they're just rolling off, and then at future dates, then it may or may not incur, additional sales. I appreciate your info. Thank you very much.
Thank you, Keegan.
Yeah, absolutely, Keegan. I think we're going to wrap up with Alpha Weekly, or Watcher, sorry. And then we'll wrap it up. Thanks, Alpha.
Thanks, man. A question for Darren or Nancy or whoever can answer, because I get a little confused with the overnight interest rate swaps or the SOFR, because my understanding is that it's just the cost of borrowing cash overnight collateralized by Treasury securities. But who is actually using SOFR to borrow? Does that include like repo window? Because what I don't understand is who's doing that when you could just go to the repo window or the reverse repo window and borrow cash from the repo window, or borrow treasuries, vice versa. Like, I don't understand the purpose of SOFR if repo window is established. Can someone just explain that to me? Because I always get confused with that.
So maybe just quickly, SOFR just went into effect in January. And I don't want to get a little too technical, but there's a convexity correction between the swaps market and SOFR. So it's not one for one. LIBOR is also still trading, although new positions are not being added in the LIBOR market. It's not going to be phased out until, I believe it's June 2023. So you kind of have all these different, US dollar funding rates. If you pull up your Bloomberg terminal, you can type, USSW, and you kind of get like it's like when you pull up, the equity markets, and you can see all the different indices. You can see there are tons of different US dollar funding rates. And a lot of they don't trade on top of each other all the time. And a lot of that has to do with funding costs. Like, a very simple example, if you look at, your screen right now, and you look at the level of, say, the 30-year interest rate, you actually get paid more yield to have the US government as your counterparty than you do, XYZ, just to pick on the Frenchies, French bank, and that's because the swap market isn't funded, right? People don't put up cash, whereas to buy treasuries, you either need to finance them with repo or you have to pay for them. And so that difference typically is the cost of balance sheet. And that's so they're not always on top of each other, but it's a bit of the rates market is, I don't want to say complicated, but there are a lot of nuances to the different level of rates. But it's not like, there are a lot of different US dollar interest rates out there. If you guys remember in the financial crisis, people were always talking about, OIS and Fed funds and LIBOR, and these things can blow out, and typically they blow out because of funding.
Yeah, I mean, I would just add, I think Nancy touched on a lot of good points there. I think, the transition to SOFR from LIBOR, right, is, I mean, we're talking about billions, trillions of dollars in the transition there. So, this is still something that's being worked out throughout the entire markets. I would also say, just based on my experience in, tri-counterparty settlements overnight, is ultimately the U.S. government is supposed to be acting as the lender of last resort, right? So that if you can't get money anywhere else, U.S. government will step in and be able to act as that lender of last resort. But what we're seeing right now is that there may be that premium to go to the U.S. government rather than other funding sources like your other counterparties at this point in time. And so, what we're seeing now in the reverse repo market is the opposite of what we were seeing in September of last year in the repo market, where we're just seeing this huge explosion of this cash that is getting parked there overnight. And essentially this is how we add or reduce liquidity in large quantities into the market to be able to facilitate additional purchases of securities and things like that. So, I mean, I don't know if that helps or adds clarity, or if you have any follow-up questions related to that. But for me, it's where, hey, the U.S. government is supposed to step in as a lender of last resort. Sometimes, in these markets that kind of turn a little bit upside down, that's not always the case.
No, that I really appreciate that. And just a follow-up question to that: are the repo facilities standing now? Because I know there was talk about that they're going to be standing, and that banks could actually hold those treasury securities and swap them out overnight temporarily, and they would make because like if they were holding, let's say, a 30-year treasury security, they could get the difference between the spread through the standing repo facilities. So it would become advantageous to actually hold those treasury securities, because then you can get the yield from those treasury securities, and when you need cash, you could then go to these the standing repo windows and get overnight cash, but then get your treasuries back like the next morning. Are they doing that now? Is that a thing?
I don't know. I'm not aware of that going on right now, but that sounds interesting.
Yeah, it was something I think talked about, like, I want to say almost a year ago now. And again, these were standing repo facilities where they were going to allow banks to basically, like I said, hold these treasury securities, and then they could just swap them out anytime they needed cash, kind of like allowed banks to have their cake and eat them too, I guess.
Yeah, you can just it's actually all public. So if you just um, put in the reverse repo agreement, RRPs, you can see, the Fed's very transparent with the New York Fed and their open market trading desks. So you can read about their reverse repo facilities and just pull it up very easily. It's all, the good thing and the bad thing is it's all very transparent. And the issue is there is a lot of when the Fed does do a reverse repo operation, they basically drain liquidity from the financial system. And that's, I think, important. Is it's not just about the balance sheet, it's also about how much liquidity there is. And you kind of need, both to be functioning in a reasonable way. So it's unclear whether, when the balance sheet is shrinking, whether there's going to be any kind of disruption, because it really depends on whether funding becomes tight. And with the reverse repo operation, the Fed is basically selling their T-bills out when they do the QT. And that takes away liquidity from the system, right? Once they sell the T-bills.
I appreciate everybody. Thank you.
Yeah, if you didn't write down that little nugget from Nancy here as we wrap up, that's on you. But definitely re-listen to it. That was Nancy. It's not just about the balance sheet; it's about the liquidity, right? And that's a phenomenal nugget to finish our evening here. So thank you for that, and thank you for jumping in. I think given the amount of interest in engaging with you, Nancy, if you're up for it, I actually meant to DM you earlier today, but you don't have to give me an answer right now. But I would love to do a bit more of a one-on-one with you, kind of focused on kind of just the bond market, fixed income in particular, volatility within, right? So we touched on a lot of this subject matter tonight, but I think given the DMs that I'm receiving, there's a lot of additional interest and folks that didn't get a chance to jump up and speak, Nancy. So if you're up for it, I would love to schedule that with you again. I'll DM you and stuff like that, but I think it'd be a really fun combo.
Yeah, I'd definitely love to. I got
Awesome.
a note from a friend when I was at this Mexican restaurant being like, hey, jump on this. So not really something I'd planned for my evening, but definitely always fun to engage and be part of the Twitter community.
I don't know who that friend is, but that makes me feel kind of special, to be honest. So thank you, and let's do it, Nancy. I'll DM you tomorrow morning, and we'll schedule something in the next couple of weeks, whatever works for your schedule. But awesome, another good weekly notebook review tonight. So thank you everyone for jumping in. I know we touched on a lot of different subject matters this evening, and hopefully you got some good nuggets for the notebook going into the back half of the week and kind of set up for next week and the months ahead. So we'll see you guys next Wednesday. What is next Wednesday? Next Wednesday is the 15th. Oh, that's not a big day at all. I don't think anything's going on the 15th, right, guys? So we'll do a post market 4:30. Oh, isn't that advantageous, right? The 4:30 weekly notebook review next Wednesday, and look for some other kind of we did a live kind of exploring the process one last week, I guess it was, and look to do a bit more of those, kind of a bit more focused on process oriented stuff, kind of how to execute, how to do those kind of things. So look for a little bit more content out of me, and we'll go from there. But all the best, everyone. Thanks again for an awesome night. Thanks to all the speakers that jumped up. We had quite a great mix of folks that contributed. So thank you very much for all the love and support. It's greatly appreciated. Have a good one.
Good night. Thank you, everyone.
Night.